infrastructure credit and specialty finance is really covering all the asset classes outside of traditional corporate credit or EBITDA. We think of them as large, economically core, important asset classes to really Main Street. So things that most people are touching every day, like an auto loan or their mortgage loan, all the way out to things that small businesses need, like equipment financing. And we're providing capital in both the public and private markets to facilitate that economic activity.
These are asset classes that are so fundamental to everyday life that it's hard to realize how big they actually are. And once you zoom out and realize that there are 150 million working class Americans, you're all of a sudden in the trillions.
It's large, it's a $14 trillion market versus the corporate market, which is sub 2 trillion. And again, a lot of people aren't focused on it, but at the end of the day, it's very important for individuals to have exposure. It's diversification from EBITDA lending and corporate finance, and it allows you to actually invest within the consumer in the United States to have access to cash flows off of real assets and have liens off of real assets that you just wouldn't otherwise have access to.
And the easiest way to think of it is as GDP grows, asset-backed credit grows, right? It's kind of directly linked to all these Main Street economic activities. So where we're really seeing that growth is the shift out of some of that credit creation historically living on bank balance sheets, moving into the non-bank ecosystem.
If you think about what the banks are doing, there's two forms of sort of this white space or financing gap that it creates. There's the retrenchment of banks from certain asset classes, but there's also the fact that there's increased bank consolidation. So this is where our capital can step in to fill in those gaps and find a flexible, again, a creative solution for these counterparties where they want to diversify many of their financing away from having to rely on just bank capital.
We have lots of longstanding relationships and partnerships going back 5, almost 10 years in some instances, and they'll evolve over time. So we may be a lender to that counterparty when either the banks aren't willing to provide them what they need or not enough. In reality, this shift from bank balance sheets to non-bank origination companies has been occurring really since the GFC. It's just been happening very organically, very slowly, but folks that were focused on it, like ourselves, have been playing a part in that growth.
We define Credit Solutions as a company that has a complex problem that needs a solution, and that solution is provided through a credit instrument.
We've taken a business that historically was viewed as a distressed business and flipped the script on its head.
We're not trying to fit a company's problem into a specific box. We're always starting with a blank sheet of paper, and when we're engaging with an issuer, we're seeking to solve some kind of really distinct, idiosyncratic challenge that's facing the company, and we come up with highly bespoke, customized solutions.
In 2020, 2021, 2022, when valuations were very high, interest rates were very low, people built capital structures for a zero interest rate environment. That clearly doesn't exist anymore. What we're seeing now is actually spreads widening and access to the primary markets being shut down. As companies will need capital for refinancings, they'll need capital for growth, they'll need capital for acquisitions. And if they don't have access to that regular way market, they're going to come to the credit solution provider.
As we think about being partners to companies, it's not only providing capital in a way that might not necessarily be available in other pockets of the market, but more importantly, truly being a partner to them. And so, post lending to a business, we work very closely with them in terms of what's going on in their companies, ways we can provide incremental capital to help them meet their goals.
We have organized our business around domain and sector experts who understand the unique attributes of the industries they cover. The only way to understand inflection points and recognize them is to cover sectors, cover companies, cover management teams. The capital that we provide is very responsive to the sector and to the company that we're looking to provide financing for.
Typically in our business, we're almost exclusively focused, depending on the opportunity set at any given moment, in either publics or privates. Having agnosticism across the two products is real edge when you're engaging with companies. And I think you have this real convergence right now where the pipeline was already incredibly deep on the private side. That actually is only going to continue to grow in the face of volatility in public markets. And at the same time, we could have an opportunity to deploy capital in a meaningful way in public markets.
We're really excited about the necessity for our capital in the market, and again, how discerning that we can be with deploying that capital.
Today, when people talk about middle market in general, they're really talking with companies in the private sector who aren't doing public executions in the lending space of $200 million of cash flow and below. Our focus on the lower middle market, especially after 20 years, it isn't by accident. It's very, very intentional.
Part of the reason for that is the lower middle market benefits from more conservative structures. There's a truer sense to the underwriting process and the credit wherewithal of the borrower, lending itself to true cash flow generation being the definition of how you quantify the amount of appropriate debt that a business can actually handle. So as a result, generally speaking, the lower middle market borrowers will come into these moments of uncertainty and have a lower absolute leverage level, a higher quality to the definition of their EBITDA, thus resulting in a higher quality to the interest coverage ratio or the fixed charge ratio associated with that borrower. They essentially are bringing more cushion into these moments of unknown, these different pressurized environments that borrowers naturally will face.
We've been through a lot of economic cycles together, where it was the great financial crisis, COVID, and really what we're seeing in the more recent environment. We think we've built a business and an organization to withstand whatever comes our way. And it comes down to picking the right private equity sponsors, structuring your deals appropriately, diversity of borrowers, diversity of industries. And I even look at the last 4 or 5 years since COVID, there's been a lot thrown at these companies. Increasing labor costs, supply chain disruptions, obviously the COVID disruptions.
I think this is when lender relationships become stronger. As I look back at the 2010 time period following the GFC, the groups that had capital and relationships were the ones that really capitalized on that. There may be some disruption, but I think with disruption comes opportunity. The importance of the relationship that we have with our private equity firms and our borrowers and how we respond in those situations, that's when a strong relationship can become even stronger, is working through those periods of distress, and we have a lot of experience doing that.
What we're watching closely is to have a little more clarity around policy, which we think will create a more certainty and a better environment for companies to be sold, whether it's a private equity firm or a privately held company. Until then, we really are challenged with the current market conditions in terms of slower M&A volume. There's still a lot of pent-up demand for private equity firms to sell their companies, for private owners to sell their businesses.
The current interest rate environment is not unknown. The current interest rate environment is something that for many of us in our 20+ year careers, we've seen a higher base rate environment and we've seen a spread premium associated with risk. So this isn't uncharted territory. This isn't necessarily new. This is a moment when fixed income matters again.
When you bring periods of economic stress to a lender, you're really highlighting your ability to continue to perform even in those tougher market environments. It really takes those periods where there is a little bit more economic chop to really have those differences highlighted.